Long before Warren Buffett became the Oracle of Omaha, before Berkshire Hathaway and billion-dollar headlines, he was just a boy quietly studying numbers while the world ignored him. At 11 years old, when most children spent coins on candy, Buffett placed his first bet on capitalism. That single decision would ignite a philosophy that reshaped global investing. How did a child turn pocket money into lifelong wealth wisdom? What principles guided him before fame, privilege, or power followed? Before we uncover how Buffett earned his first $1,000, and the lessons hidden inside, like, subscribe, and join us as we trace history's most disciplined mind at its very beginning. Warren Edward Buffett was born in 1930 in Omaha, Nebraska, into a household where money was discussed openly but never worshipped. His father, Howard Buffett, was a stockbroker and later a U.S. congressman, exposing young Warren to balance sheets instead of fairy tales. While the Great Depression ravaged families, Buffett obsessively tracked numbers, memorized baseball statistics, and calculated odds for fun. Money, to him, was logic, not emotion. He learned early that financial survival required discipline, patience, and probability. This environment shaped a child who viewed markets not as casinos, but as puzzles waiting to be solved carefully. In 1941, at just 11 years old, Buffett made his first investment, 3 shares of Citi's Service preferred stock at $38 per share. The decision wasn't impulsive, it followed careful observation of price movements and dividend yields. When the stock briefly dropped to $27, Buffett panicked, experiencing his first taste of fear. But he held firm. When prices recovered to $40, he sold quickly, relieved. Shortly after, the stock soared past $200. That moment burned permanently into his mind. Buffett learned a brutal lesson early. Emotional impatience is often more expensive than market mistakes themselves. Before earning $1,000 from investing, Buffett mastered something equally powerful, earning capital. He delivered newspapers, sold golf balls, operated pinball machines, and flipped used items for profit. By age 13, he was filing tax returns, deducting bicycle expenses as business costs. These weren't childhood games, they were experiments in cash flow, scalability, and margins. Buffett understood that investing required fuel, capital, and capital required discipline. Every dollar earned had a purpose. Unlike his peers, Buffett delayed consumption, choosing compounding over comfort. These small hustles built not just money, but the psychological foundation for long-term wealth creation. Buffett's genius wasn't speed, it was patience. By his teenage years, he fully grasped compounding's quiet brutality. Small sums, reinvested consistently, could overpower time itself. Instead of chasing excitement, Buffett tracked interest, dividends, and reinvestment cycles. He calculated future values obsessively, projecting decades ahead. While others chased quick profits, he learned that wealth favored the disciplined and boring. Compounding became his religion, time its greatest ally. The realization was simple but devastatingly powerful. Money working steadily would always outperform money chased emotionally. This philosophy would define every decision he made from that moment forward. By the age of 16, Warren Buffett had accumulated over $1,000, a staggering sum in the 1940s. Adjusted for inflation, it represented tens of thousands today. This wasn't luck, it was structured repetition. Paper routes, reinvested earnings, disciplined spending, and early market exposure converged. Buffett didn't celebrate extravagantly. Instead, he reinvested. To him, $1,000 wasn't success, it was proof of concept. The system worked. He had verified that discipline beat talent, and patience beat intelligence. This milestone validated a belief that would shape global finance decades later. Wealth is built methodically, not dramatically. Buffett's greatest teachers weren't traders, they were books. He devoured Benjamin Graham's The Intelligent Investor, absorbing the concept of intrinsic value and margin of safety. Markets, Buffett learned, were emotional crowds, not rational judges. Prices moved wildly, but value remained grounded. This separated him from speculators early. While others followed noise, Buffett followed numbers. He learned to treat stocks as businesses, not lottery tickets. This intellectual isolation, thinking independently while others chased trends, became his greatest advantage. From childhood, Buffett trained himself to stand alone, guided by data rather than applause. Buffett's early experiences taught him something more valuable than formulas: emotional control. Watching Citi's service skyrocket after he sold taught him restraint. Watching markets fall taught him courage. He learned that fear and greed were predictable, repeatable patterns. Rather than fight emotions, Buffett designed rules to avoid them. He invested with long horizons, clear criteria, and minimal trading. This discipline turned volatility into opportunity. By mastering his psychology early, Buffett achieved something rare: consistency. Markets could swing violently, but his behavior remained calm. That emotional stability became the foundation of every fortune he later compounded. While many sought leverage to accelerate gains, Buffett avoided debt aggressively. His early philosophy rejected borrowing to invest, believing risk multiplied faster than returns. Instead, he waited until he had cash. This conservative stance protected him from ruin and preserved optionality. Speculation promised excitement. Buffett preferred certainty. He avoided trends, rumors, and unproven ventures. This restraint made his growth slower, but far safer. Buffett learned early that survival mattered more than speed. Those who stayed solvent longest controlled the game. It was a lesson forged in the shadows of the Depression, and it shaped his entire investing life. Even as a teenager, Buffett thought in decades. While others planned weekends, he projected retirement. Time became his edge. Long holding periods reduced taxes, minimized mistakes, and amplified compounding. Buffett realized that frequent trading rewarded brokers, not investors. His early investments reflected this patience. He wasn't chasing momentum, he was building permanence. This mindset allowed him to ignore market noise and focus on fundamentals. By aligning time with value, Buffett created an invisible advantage few recognized. Markets punished impatience, but rewarded endurance. Buffett chose the long road early, and never looked back. Buffett's early success wasn't built on complexity. He avoided advanced formulas and complicated strategies. Instead, he asked simple questions: is this business understandable? Is it profitable? Is it cheap? That simplicity protected him from overconfidence. He believed complexity often disguised ignorance. By focusing on fundamentals, Buffett avoided traps others fell into. This minimalist approach allowed clarity in chaotic markets. Even as a child, he resisted unnecessary sophistication. His early $1,000 wasn't earned through genius, it was earned through clarity. This simplicity would later scale into one of the greatest investment empires in history. When Buffett earned money, he didn't reward himself, he reinvested. Consumption was delayed, gratification postponed. This discipline separated him from peers. While others upgraded lifestyles, Buffett upgraded capital bases. Reinvestment became automatic. Every dollar earned had a job. This behavior compounded results faster than intelligence ever could. Buffett understood that lifestyle inflation killed wealth quietly. By resisting it early, he preserved growth. This habit, formed long before fame, ensured that his fortune expanded while his needs remained modest. The $1,000 milestone wasn't spent, it was multiplied. By adulthood, Buffett's philosophy was complete. He didn't invent it later, it was forged early. Value over price, patience over excitement, discipline over ego. These principles guided every future success. His childhood experiences weren't footnotes, they were blueprints. The $1,000 milestone wasn't just financial, it was philosophical confirmation. Buffett had tested his beliefs against reality, and they worked. From that moment onward, he scaled principles, not experiments. This consistency is why his record remains unmatched. He didn't evolve strategies, he refined discipline. Buffett's first $1,000 teaches timeless lessons. You don't need brilliance, just consistency. You don't need speed, just patience. You don't need luck, just discipline. Markets change, technology evolves, but human psychology remains constant. Fear, greed, impatience, these forces destroy wealth repeatedly. Buffett mastered them early. His story proves that wealth is less about opportunity and more about behavior. The greatest edge isn't information, it's temperament. That lesson matters today more than ever. Anyone can copy strategies. Few can copy discipline. Warren Buffett's first $1,000 wasn't the result of privilege or shortcuts. It was the product of patience, discipline, and clarity long before the world paid attention. His story reminds us that greatness compounds quietly, built from small, intentional decisions repeated relentlessly. Markets reward those who respect time, control emotion, and think independently. As you reflect on Buffett's beginnings, ask yourself, are you chasing excitement or building permanence? If this journey into financial history inspired you, like, subscribe, and continue exploring the moments where quiet decisions reshape the world. Wealth begins long before the numbers show it.